Last week we had a lot of companies in the S&P 500 report their earnings. On top of that, we also had the latest Fed meeting where in fact they declared that the progress on inflation has stalled and therefore they are looking to keep those rates steady in the shorter term. And we can see how the market has reacted. Just last week, we see a lot of mixed results. Notably, we see Apple up 8% as well as Starbucks down 17%. And into next week, we also have a lot of major companies reporting their earnings. Now, today's focus, we are taking a look at 6 undervalued dividend stocks right there at their 52-week lows. With a lot of upside, we're looking at each one in detail, their historical performance. We're going to look at their dividend safety, their underlying metrics like the free cash flow, the ROIC, their debt levels, and as always, we will run them through the valuation model, getting to both our intrinsic value as well as our acceptable buy price, given that investor margin of safety, and we'll also look towards Wall Street to see what they are forecasting for the next 12 months. So let's jump in and start with the first company, which is Bristol Myers Squibb. Now this has been hammered down over the last 12 months, negative 34%. We see it there, right there, trading at its 52-week low. Although we do know 1 buy rating and 2 hold ratings. It currently offers a forward yield of 5.46%, and we do note that over the last 10 years, if you have been a shareholder, you would be down negative 14%. If you include dividends reinvested, it would be slightly higher, but over the longer term, this has been a very poor performance, and we do know all-time highs November 2022 at $81. So let's take a look at this company, their underlying features. Dividend safety score, very important for a company with a yield above 5%, 70, so it does look to be safe. Market cap just under 90 billion. It is a large cap company. In terms of the dividend safety, they just got reaffirmed just a few weeks ago, so we can see that a dividend cut does look to be very unlikely. In terms of looking at the historical performance in the last recession, 07-09, when a lot of stocks did crash, we do know BMY maintained their dividend. They didn't increase it, but they also didn't cut it. They had below average growth, negative 21%. Bear in mind the S&P during this period, average growth was negative 12, but they did outperform the S&P 500, negative 32%, with the S&P coming in at negative 55. In terms of dividend growth, well, pretty decent for a yield of over 5%. Just last December, they increased it by 5.3%. That is above the 4% we advocate on the channel to get, whether that's your salary, dividends, or other income-producing assets, just to keep up in line with inflation. Nice high single digit, 7% on average over the last 5 years. And over the last 20 years, at a minimum, they are keeping up those increases in line with inflation. In terms of the number of years, well, they have been increasing the dividends for the last 17 years, whilst paying a dividend for the last 53 without a reduction. As always, dividend yield theory does state a company is undervalued when the current yield sits above the 5-year average. We have a severe undervaluation signal here, 5.46 versus a 5-year average of 3.15. We also note the forward P at 6.6 is significantly lower than the 5-year rolling of 9. And when we also look and incorporate the healthcare sector PE of 16.1, BMY does hit much lower. Now, yes, these are undervaluation signals, but bear in mind we don't look at any of these models in isolation and conclude towards the end. Now, just a quick reminder, free cash flow, it is always what you want to look at on the payout. Earnings is susceptible to manipulation by management through accounting, and we can spot dividend cuts by looking at these free cash flow payouts. Personally, below 60%, my own blanket rule gives me faith that management are able to offer those double-digit dividend increases we love to see. For biotechs, if you want to be industry specific, 50%, and we know in fact since 2018 it has been below 50%. 2024 expected 35%, so this is very positive for this company. We can understand now why the dividend does look to be safe. On top of that, always invest or analyze companies that increase their free cash flows. That is what you want to see in any company you put your money towards. Now, we do know that it has been inconsistent, but over the longer term, it is increasing around 4 times over the last 10 years. And we also note an increase anticipated in FY24. When we take a look at sales growth, well, 3 to 7% is the steady moderate growth we see as a baseline. They have achieved that for the large part of the last 10 years, although we note the last 2 years have been fairly poor, 0% in 22, negative 2% in 2023. Now, sales growth, they have been increasing their top line, in fact, 3 times over the last 10 years. The only thing we would say is that over the last 4 years, it has been fairly stagnant, so do incorporate that into your own investment thesis. And with shares outstanding, as always, ideally we want to invest in companies that do share buybacks, returning the excess cash to investor pockets. What we know, though, they have done the opposite and diluted your position as a shareholder if you did invest in 2014. But since 2020, we do know they have done some small share buybacks over the more recent times. ROIC, return on invested capital, what we want to note here is 10% or more, just to give us faith that management are able to effectively allocate their capital. I want to see 10% or more, but again, biotechs, they do warrant a slightly higher, around 25%. Last 3 years, not too bad, but ideally we want to see the highs of 2014 to 2018 around the 20s. In terms of the margins, very important, we do like companies with higher margins. What we can see for biotechs, 25% or more, they've straddled around that over the longer term, but the last 4 years they have really struggled to get anywhere near. Something to keep an eye on, but around that 20% at a bare minimum is okay. And on the free cash flow margin, a lot healthier. In fact, since 2017, looking very strong. It is a good free cash flow machine. Now, net debt to EBITDA, this is a very important one. What I would say here is that it does correlate to both dividend safety as well as balance sheet strength. EBITDA referring to the earnings before interest, tax, depreciation, amortization, and these numbers are effectively the number of years it would take the company to pay off all of their debt net of cash on hand. Below 1.5, one thing we would say is over the last few years it has been around that level. 2024 expected 5.57, so that is a very big jump, something that I would say massively keep an eye on as their debt levels look to be increasing. But something that so far it does look to be okay. The dividend does have that 70 score, but as always there are considerations that you can include into your margin of safety. So let's jump into the valuation model. As always, if you do enjoy the content and values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we do deep dives of these companies running through every single model. Today's episode, we're going to jump straight into the model, and the intrinsic value is purely the average of these 4 models. In today's episode, arriving at $64. Now, current price, just $1, or in fact, just a cent shy from $44. We do use a margin of safety of 10%. We only execute on 10% if we believe it meets the 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. And then we keep going till it's near that current trading price to understand what MOS level we have in today's episode. And we can see pretty much around a 30% margin of safety based on our estimates and judgments, up to around $45. What about Wall Street? Well, they indicate upside around 21% just over the next 12 months. They have a price target of $53.27, which is decent when you incorporate you are also getting a yield of over 5%. However, as always, as we go through these stocks, do let us know if you are buying any of these, or at a minimum, they are on the watch list. Now, before we jump into the next stock, just to let you know, we have released our latest free weekly article. If you want to gain access to this or any others, all completely free, do click on the pinned comment below. You can start reading straight away. We do want to draw your attention to this article here. If you want to know what are the websites we use to analyze these stocks on the channel, all of them are free and readily available to check out in this article. Moving on to the next undervalued dividend stock, and we have a triple buy rating, seeking alpha, Wall Street and quant. We have Johnson & Johnson. Now, it is down around 8% over the last 12 months. If you've been a shareholder over the last 10 years, you would be up around 48%. Again, if you reinvest those dividends, you would be up slightly higher. It is trading right there towards its 52-week low, and in terms of the forward yield, it is sitting at over 3%, 3.32, with a forward P of 14. Just bear in mind, if you want to compare it to the S&P 500, that is currently trading at a forward P of around 22. Now, in terms of looking at the dividend safety, 99, very safe and the highest score obtainable. 359 billion, it is a mega cap company, and we can see it was reaffirmed this very safe score only a few days ago. In terms of the previous recession, how did they perform? Well, they increased the dividend during the 07-09 crash, above average sales, and the recession return negative 27%, a lot better than the S&P. Dividend growth, well, they did in fact increase it just last month, 4.2%. Not the greatest, given that it's just in line with inflation, especially over the last 5 and the last 20 years. We do see more towards the high single-digit increases. But we do note two things. Firstly, they are a dividend king. They have increased those dividends over 50 years or more. In fact, equally as impressive, they have been paying a dividend for the last 108 years without a reduction. In terms of dividend yield theory, then no surprises, a double undervaluation signal both on the yield as well as the forward PE. We also note the healthcare sector PE does sit higher at 16.1, so that is a triple undervaluation signal. In terms of the free cash flow payout, well, as always, below 60%. We do note for the majority of the last 10 years, it has been below. Last 2 years, trading more towards that 70%. Good to know full year 2024 around 55%. So it is understandable why there are no worries with those dividends. Now, something to bear in mind, we do like to see increasing free cash flow, but the rate at which these companies will increase will also depend on what type of company they are. Something like Johnson & Johnson is a lot more mature than, say, a tech company that is increasing at rapid rates. Good to note, though, over the longer term it is increasing. Full year 2024 expected an increase as well. Sales growth, we note 3 to 7% roughly on average over the last 10 years, but fairly inconsistent, and some periods where it has been fairly poor, 2019 to 2021. The last full year at 6% is also very positive, with the trailing 12 months showing 11%. Now, in terms of their total sales, we do note it isn't the greatest, as we said, but overall it does increase over the longer period. And with their shares outstanding, we do note some share buybacks, although minimal every single year, something just to note there. In terms of the ROIC, we love the consistency, very, very strong, above 10%, in fact in the 20s nearly every single year. Last full year, 23%, making it very attractive to those potential investors. Margins as well, very strong. We love to see, one, a strong metric, and two, the consistency, something we see across the board on both the operating margin as well as the free cash flow margin, which does give us good faith in investing in a company over the long period. In terms of the net debt to EBITDA, they do have one of the best balance sheets there globally alongside Microsoft with a very strong rating. 0.25 in 2023, 0.23 in full year 24. So as we can see, no worries with the dividend safety, no worries with their balance sheet strength. So let's jump into the valuation model. Don't forget you can grab a copy of this model to get to both the intrinsic value as well as the acceptable buy price of companies in your own portfolio or those on your watch list by clicking on the pinned comment below. 10% MOS level, a buy up to 168, at 15% up to 158, and at 20% we can see pretty much around the current trading price. So this has historically been a strong, consistent company, and it is one that if you do like a lower volatility in the portfolio, it could be one for consideration. At a 20% MOS level, as well as Wall Street, we note nearly 20% upside, in fact 17, with a price target of $174.62 over the next 12 months. As we saw at the beginning, a triple buy rating from those analysts, but don't forget to let us know your thoughts below. The next undervalued dividend stock that we have for your attention is MSCI. Now we do know 2 buy ratings, 1 hold rating, right there towards its 52-week low. Does have a lower yield than the previous stocks at 1.37% and does trade at a forward PE of 31.7. Now over the last year it is pretty much flat. However, over the last 10 years it is up over 1,000%, and we also note all-time highs sitting around $664 at around October 2021, so nearly 3 years ago. In terms of dividend safety, well, we have a score of 61. It does look to be safe. Market cap 37 billion. It is a large cap company. Now again, reaffirmation of that safe. We do note a dividend cut is unlikely for MSCI. And when we look at the metrics from the previous recession, they didn't pay a dividend, so no comparative data, but they had plus 1.5% recession sales, a lot better than the negative 12 of the S&P. We love this company for its dividend growth as one reason. Double digits just this year. 24% on average over the last 5 years, and we can note they have been increasing those dividends for the last 9. In terms of dividend yield theory, we can see again that double undervaluation signal on both the yield as well as the forward PE, although we do note that it is significantly higher than the financial sector at 11.6. To bear in mind, there are a lot of stocks in here, and when we do strip out and look at the ones that are very similar to MSCI, it would be showing a much higher forward PE. Now in terms of the payout ratio, always important to look, it is very low, in fact below 40% every single year, 38 expected in 2024. One of the reasons why they are able to offer those strong double-digit increases. And one thing I love to see, a lot of consistent growth over the longer term. In fact, nearly 7 times free cash flow growth and continually expected into FY24. So this is so far a very high quality company with some high quality metrics. We then move on to the sales growth, double digit nearly every single year. 21% in 21, 10% in 2022, and the more recent year showing 12%. That is something you really like to see with companies that you invest in, and we can see numerically they have grown more than 2.5 times over the last 10 years. If that wasn't good enough, well, they also do a lot of share buybacks, as we can see, over the longer term. So that is very positive, increasing your ownership over a company. ROIC, now there are two reasons why we like this. Yes, very strong, but also it has been increasing at a very good rate. 33 in 2022, which was very good. 35 in 2023, which is phenomenal. So this is a great company, a lot of very positive metrics. Now, if you're regular viewers, you know we like not just increasing revenue, but operational efficiency. Their margins has gone from 34% 10 years ago to 55%, and it doesn't look like stopping. Nearly an increase every single year on their margins. Very positive, and one of the best free cash flow margins we have seen just over the last 6 to 7 years in the 40s is very attractive. Not just this metric, but a lot of them for investors as well as those who are sitting on the sidelines considering. Net debt to EBITDA, probably one area where we would like to see a little bit better. Yes, it is below 3, but ideally a lot lower would be a lot stronger in the sense of both dividend, but more importantly, the balance sheet strength. Nice to note a drop expected to 2.3 in full year 2024. So let's get into this company, which does look to be a very high quality company. In terms of the intrinsic value, well, the average is just these two models coming to $627. Now let's get to it. The current price is $467 at a 10% margin of safety. It would be about to $564. 15% up to $533, at 20% $501, and we keep going till it's near the current trading price, and we see a 25% MOS level, which we believe to be very strong for a company when you purely look at the financial metrics, looking to be a very good contender for one of the best companies in your portfolio. In terms of Wall Street and their forecast, well, if that wasn't good enough, they see 33% upside to the current trading price, a $623 target, pretty much in line with our intrinsic value as well. But again, let us know your thoughts, whether this is one that you've even considered or come across before as well. We then move on to one of the stocks that had its worst weeks last week. It was Starbucks Corporation, down 2.5% just on Friday, but over the last year, down 30%, year to date down 24%, and when we just look at last week itself, down 17%. Now, if you've been a shareholder over the last 10 years, you would be up 108%, but you would be quite some way away the all-time highs of $126 in July 2021. As we can see right there at the 52-week range, it does have a yield now significantly over the 3% level and a strong buy rating from Wall Street, however a hold from the other two analysts, and the forward P now marginally lower than the S&P 500. Now, one of the reasons we did want to discuss this stock again, because we did cover it not too long ago, but unfortunately they did get a downgrade on their dividend safety to 60, borderline safe. Market cap now 83 billion. It is a large cap company. And as we can see, they were in fact downgraded just a few days ago. So the talk of a dividend cut is suggested to have moderate risk now over a full economic cycle. In terms of the last recession, well, no dividend was paid. However, they had above average growth, although marginally, but they did trail the S&P negative 69%. Dividend growth 7.5% last September, nice double digit over the last 5 years and 10 years, but we would say something just to consider. Given that downgrade, the increases over the next few years may not be as strong as they previously were, and we do note 13 years of consecutive dividend increases. Now, dividend yield theory, we do note a strong double undervaluation signal both on the yield as well as the forward PE, and when we compare it to consumer discretionary though, it is still significantly higher. Now, what's important for dividend safety? Well, one of those is the free cash flow payout. Yes, below 50% for the restaurant industry. It has been fairly high just over the last 2 years in comparison. Important to note, full year 2024, it is expected to go higher to around 71%. Increasing free cash flow, it is very important. It is one of those metrics that we want to see in any company we consider for the portfolio. It has increased over the longer term, but it is inconsistent. 2024 expected to be pretty much in line with full year 2023. Sales growth, no surprises here. This is a company that does increase their top line double digit fairly consistently. However, we do note that justifiable COVID drop. And we would say, though, based on their latest quarter, it does look like the growth will start to drop down into the single digits into full year 2024. Sales growth, they have more than doubled their top line over the last 10 years. And when we do analyze the shares outstanding, we can see over the longer term, they have been doing a lot of share buybacks, but we can see from 2020, it has been very marginal. So in the more recent period, this may not be something the company does look to focus on. ROIC, well, very strong consistently in the very, very high double-digit numbers. 33% in 2023, something that all investors do like to see as one of those main metrics. In terms of the margins, well, it does straddle around the 16% for the restaurant industry. As long as it does keep around that, there are no main worries. And with the free cash flow margin, whilst we may not classify it as a free cash flow machine, it is still very strong, especially over the more recent period. Finally, net debt to EBITDA. Now, we wouldn't say a dividend cut is going to come. We can see, yes, the free cash flow is going to around the 70% level, but as long as the net debt to EBITDA is below 3.5, and it is expected to be around 2.1 in full year 24, then for now it does look to be okay, but something we can keep an eye on moving forwards as they do report both quarterly earnings as well as their annual report. So in terms of the valuation, this is a very important one for this company, and the intrinsic value is the average of these three models, coming to just under $107. Current price, $73. Now, margin of safety, we do start off with 10%, but we can see Starbucks is trading at a fairly strong MOS level. Right now, around 30% margin of safety based on our estimates and judgments, acceptable by just under $75. If you want to see a more in-depth dive of this company, we did review it just last week, so do check that out. But it is trading at a 30% MOS level, with Wall Street giving it 41% upside. Their price target, $103. As always, let us know whether or not you have been adding to this stock. Maybe it's on your watch list. For me, this is one that I did add just last week, although not a massive portion or in terms of the portfolio, but it is one that I will continue to add if it does continue to drop. But at a 30% MOS level, it does look like a very strong contender. The next company that we are taking a look at is Nike. Now, we do have a buy rating from Wall Street and 2 holds. We do know it is towards the 52-week low, down 27% just over the last 12 months. Over the last 10 years, though, we do note it is up 151%. All-time highs sitting around that $170 mark at the back end of 2021. It does have a forward yield now of 1.61% and a PE 27, sitting significantly above the S&P's 22. So let's take a look. Dividend safety, the highest score obtainable, very safe. Market cap, $139 billion. It is a mega cap company. Reaffirmed the dividend safety just last month, so no worries there. In terms of the last recession, well, they increased the dividend above average growth, and they also beat the S&P 500. Dividend growth itself, well, 8.8% last year, 11% over the last 5 years. Strong double digit over the last 20 years. If they do continue this, then they will be a very strong dividend growth company for the portfolio. They're 4 years away from becoming a dividend aristocrat, and they have also been paying a dividend for the last 39 years without a reduction. So let's take a look at undervaluation, and we do note both on the yield as well as the forward P, a double undervaluation signal, so it does look like it is a very strong contender for one of those to consider in the portfolio. Consumer discretionary, however, does sit much lower at 12.3. How about the free cash flow payout? Well, again, below 60%. It has been there every single year, bar that COVID year, so no worries, and it is expected to go lower into 2024, so we should expect a nice dividend increase fairly soon. Free cash flow, a little inconsistent, but it has been increasing nearly 3 times. FY24, that trend is expected to continue, always a positive sign. And when we take a look at sales growth, even though we do see one negative year, the rest of the years have been fairly strong, 10% just in the last full year, although we want to point out on the trailing 12-month basis, we do see low single digit of 2%. Numerically speaking, though, they have nearly doubled their top line just over the last 10 years, and we also note some marginal share buybacks over the period. Always a nice bonus to investors, especially when they are getting a nice increase to the dividend. Now, in terms of the ROIC, again, pretty healthy, double digit, 21% in the more recent year. Nothing negative to note there. And when we look at both margins, operating and free cash flow, looking fairly healthy. Now, on the operating side, maybe one to look at, but it has been consistently around the 12% level. Free cash flow margin pretty much every year looking very healthy. Finally, we get to the net debt to EBITDA. No worries whatsoever. 0.18 expected next year, 0.19 in the full year 2023. So they do have a very healthy balance sheet. So we can see why, in fact, the dividend does look to be safe. No glaring issues with this company. When we take a look at the valuation, and as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Margin of safety at 10%, we note pretty much a buy at this price, $92.25. Depends though with every investor what MOS level they are satisfied with. However, when we do take a look at Wall Street, they do believe the price will go much higher than our intrinsic value, and they do anticipate 21% of upside. So let me know if this is one that you also believe is in line with Wall Street and you do expect some nice upside over the next 12 months. But also with any of these stocks we are going through today, if you do see any negatives, any bearish sides, also drop your thoughts below. We then take a look at the next undervalued dividend stock with 2 buy ratings. It is Comcast Corporation. Now this is down 5.4% over the last 12 months. Over the last 10 years, however, up 50%, but we can see it has fallen significantly at $61 3 years ago. And we do note right there towards their 52-week low, in terms of a forward yield, 3.2%, and a fairly low forward P sitting around 9.19. Dividend safety, well, very safe, 89 score, market cap 152 billion, a mega cap company, and a recently reaffirmed dividend score looking to be very safe. In terms of those metrics, well, they increased it during the last recession. They had plus 3.4% growth, but a near S&P return at negative 52%. Now, they did just increase their dividend not too long ago, 6.9%, although we note over the last 5 and the last 10 years, slightly stronger increases, but they have been increasing those dividends for 15 consecutive years. In terms of looking at dividend yield theory, again, a double undervaluation signal both on the yield and on the forward P, but we do want to remind you that we don't look at any of these in singularity. It is also much lower than the communications sector P of 17.8. Free cash flow payout, love to see the consistency, nearly around 30 to 40% every single year. FY24, 38%. So really interesting to note with companies with very safe dividend scores, there are a lot of common themes like those low free cash flow payouts. They have also been increasing that free cash flow. The trend is very good. FY24 expected an increase to $3.27. Sales growth, now very mixed. We do like to see 3 to 7%, which they have pretty much smashed through up to the last majority of the last 10 years. Although 2023, we do note 0% and the trailing 12 months at 2%. Something just to keep an eye on, and we will keep a look when we do read their quarterly and annual reports moving forwards. Total sales, they have nearly doubled their top line, and they have bought back over 1 billion shares outstanding over the last 10 years, although inconsistently they do go through patches where they buy a lot of shares. We then take a look at the ROIC, very consistently around the 10 to 11% level, so you know that is what we want to see at the bare minimum, so it does look to be healthy. And we know whilst it is above the 12%, yes, it is very positive, 19%, a little bit of operational inefficiency with increasing revenue but decreasing operating margin, something just to consider in your investment thesis and MOS level. Free cash flow margin, very consistent, so that does look very healthy. Net debt to EBITDA below 3 for the majority, and it is decreasing since the highs of 2020, and we do note full year 2024 2.27, so no worries with both dividend safety and the strength of that balance sheet. How about the valuation? And don't forget you can grab a copy of this valuation model to get to both the intrinsic value as well as the acceptable buy price of companies in your own portfolio, as well as those on your essential watch list. So margin of safety then, current price $38.69, intrinsic value at $50, 10% up to $45, 15% up to $42.53, 20% around $40, and we do know not quite there yet at the 25%, between a 20 to 25% MOS level for today's episode based on these judgments. In terms of Wall Street and their forecast, well, we're saying 20 to 25% MOS level. Wall Street is saying 26% upside with a price target of $48.60 over the full year. Now, you are, don't forget, getting a fairly nice starting yield of over 3%. But as always, let us know your thoughts in the comments below on these 6 undervalued dividend stocks, if you've been adding any over the more recent period. And if you enjoy this episode, smash that like button, hit that subscribe and bell button. And as always, we'll see you all on the next one.